In 2026, a single unchecked box on your tax return could trigger a chain reaction you never saw coming. Not because you were hiding money, not because you did anything criminal, but because the rules quietly changed and almost no one is talking about it. If you're over 60, if you hold a green card, if you were born outside the United States but file taxes here, you're about to be placed under a level of scrutiny that didn't exist before. And the consequences aren't just financial. We're talking automated IRS flags, audit exposure, immigration delays, and in some cases, citizenship applications thrown into limbo for months. I've seen it happen. One small overseas account, one missed reporting form, 8 months of stress, thousands of dollars in legal fees, all because someone didn't realize the landscape had shifted beneath their feet. The most dangerous part, this change is already finalized. It's written into policy. And when you sit down to file your 2026 taxes in early 2027, the system won't care that nobody explained it to you. So today we're going to unpack exactly what's changing, why seniors and immigrants are being affected the most, and what you can do right now to protect yourself before this becomes your problem. Hi, I'm Sofia, and for years I've been tracking the intersection of tax policy and immigration rules, especially the kinds of regulatory shifts that quietly impact seniors, green card holders, naturalized citizens, and long-term visa holders. I've watched too many hardworking families get blindsided, not because they were dishonest, but because they simply didn't know a reporting requirement applied to them. My goal here isn't to scare you, it's to make sure you're never caught off guard. Think of this channel as your early warning system. When something changes that could affect your finances, your immigration status, or your long-term security in this country, I break it down in plain English so you can act before it becomes a crisis. And what's coming in 2026 is exactly the kind of change you want to understand early, because once the new system is in motion, fixing mistakes becomes much harder. Let's talk about what's actually changing. So here's what's actually happening. The IRS has finalized a new reporting framework that takes effect starting with the 2026 tax year, which means when you file in early 2027, you'll be operating under an entirely different set of expectations. This isn't a rumor. It isn't speculation. It's embedded directly into updated filing instructions and compliance procedures tied to Form 1040 and related foreign asset reporting requirements. And the key shift is this. Questions that used to live quietly on specialized international forms are now being pulled front and center onto the main tax return that everyone files. In other words, what used to apply primarily to high net worth or internationally complex taxpayers is becoming unavoidable for everyday seniors and immigrants with even modest overseas ties. Under the new structure, expanded foreign asset disclosure questions are being integrated more directly into the standard filing process. That means you won't be able to simply overlook them because your accountant didn't mention it or because you never thought it applied to you. The system is forcing clarity. If you have foreign bank accounts, overseas pensions, foreign social security type benefits, shared property abroad, or any kind of financial footprint outside US borders, the form is going to ask you directly, and your answer won't exist in isolation. It will be digitally compared against other filings connected to your name. Now, here's where many people get confused. You might be thinking, I've always answered the foreign account question on my tax return. What's different? The difference is scope and enforcement. Previously, many of the deeper disclosure requirements were triggered only after certain high thresholds were met, and they often required separate specialized forms that most average taxpayers never encountered unless an accountant specifically flagged it. Starting in 2026, that separation narrows dramatically. The reporting system becomes more unified and much harder to unintentionally bypass. But the real shock isn't just the visibility of the questions, it's the thresholds. Under the previous rules, if you were single and living in the United States, you generally only needed to file Form 8938, the Statement of Specified Foreign Financial Assets, if your foreign holdings exceeded $50,000 at year end or $75,000 at any point during the year. For many seniors and immigrants, that felt safely out of reach. A modest savings account overseas, probably under the limit. A small co-owned property, maybe not counted clearly. A pension sitting quietly abroad, often misunderstood. Under the 2026 framework for taxpayers in higher risk reporting categories, including individuals over 60 and many immigrant filers, those thresholds are effectively tightened in practice. We're now looking at trigger points closer to $25,000 at year end or $40,000 at any time during the year in comparable scenarios. And remember, any time during the year means peak value, even if the account balance only crossed that line for a single day. Think about how easy it is to cross that without realizing it. Maybe you co-own property overseas with siblings and your proportional share pushes you above the limit. Maybe you have an inherited pension account you never liquidated. Maybe your elderly parents temporarily transferred funds into a joint account in your home country. You weren't trying to conceal anything, but the peak value crossed the threshold. And that's what matters. And this is exactly where people get blindsided because most taxpayers don't track peak balances across international accounts unless they've been specifically advised to do so. They look at year-end statements, they assume consistency. But Form 8938 doesn't just care about what was there on December 31st. It cares about the highest value at any moment during the calendar year. Now, if this is already helping clarify things for you, take just a second to like the video. It genuinely helps more seniors and immigrant families see information like this before it becomes a problem. And that early awareness can make all the difference. Here's what's critical to understand moving forward. Once these lower reporting thresholds intersect with expanded visibility on Form 1040, the margin for accidental non-compliance shrinks dramatically. You don't have to be wealthy to cross these numbers. You just have to have modest, ordinary financial ties abroad, which millions of immigrants and retirees do. And this is only half of the equation, because the other half involves how the IRS cross-checks your answers in ways that didn't exist at this level before. Now, let's talk about the piece that makes this far more serious than just extra paperwork. It's not only what you report, it's how your answers get verified. There's another filing requirement called the FBAR, the Foreign Bank Account Report. Unlike Form 8938, the FBAR isn't filed with your tax return. It's submitted separately through the Treasury Department's Financial Crimes Enforcement Network, and the threshold for that one hasn't changed. If the total combined value of all your foreign financial accounts exceeds $10,000 at any point during the year, even for one single day, you are required to file it. Notice I said combined value. That means if you have $4,000 in one account, $3,000 in another, and $30,500 in a third, you've crossed the $10,000 line. It doesn't matter that none of them individually hit $10,000. It's the aggregate total that counts. For years, one of the biggest problems wasn't intentional concealment, it was fragmentation. People answered yes on their tax return about having a foreign account, but didn't realize they also needed to file an FBAR. Others filed an FBAR, but failed to include required details on Form 8938. The systems weren't always seamlessly integrated, and many inconsistencies slipped through without immediate detection. That's what's changing under the newer enforcement framework. Cross-referencing between your Form 1040 responses, Form 8938 disclosures, and FBAR filings is far more automated and immediate. If you check yes to having foreign accounts but no corresponding FBAR appears in the database, that discrepancy doesn't sit quietly. It gets flagged. If you file an FBAR showing certain accounts but fail to reflect those assets properly on your tax return, that mismatch is detectable. These systems now communicate in ways that dramatically reduce the chance that inconsistencies go unnoticed. Imagine this scenario. You've maintained a $12,000 savings account in your country of origin for years. You use it when you visit family. It earns minimal interest. You never thought of it as a big deal. Under the older environment, you might never have been directly confronted about it unless an audit occurred. Under the new structure, you'll be asked clearly on your main tax form whether you have foreign accounts. If you answer no because you think it's insignificant but financial data reporting shows otherwise, that contradiction becomes visible immediately. And here's where this moves beyond taxes. If you're a green card holder, your tax compliance history isn't just a financial matter. It's part of your immigration record. When you apply for naturalization, USCIS has the authority to examine your tax filings to evaluate good moral character and adherence to U.S. law. Historically, that review might have required manual document requests or selective investigation. Increasingly, data sharing protocols streamline that process. This does not mean that every discrepancy equals denial. That's important. But it does mean enhanced scrutiny is more likely if inconsistencies appear. Missed FBAR filings, required forms not submitted, contradictory answers about foreign assets. These can trigger additional questioning, requests for evidence, or processing delays. And delays are not minor inconveniences. They can mean months of uncertainty, missed oath ceremonies, travel complications, emotional stress during what should be a celebratory transition to citizenship. If you're already a naturalized citizen, you might assume you're insulated, but tax compliance obligations remain identical. The reporting framework doesn't distinguish based on birthplace once you're a U.S. taxpayer. If you maintain financial relationships abroad, which many naturalized Americans understandably do, you're still subject to these rules. For employment visa holders, H-1B, L-1, Z-1, or others, the risk plays out differently, but just as seriously if you meet the substantial presence test and are considered a U.S. tax resident, these reporting rules apply to you. And if you later apply for status adjustment or visa renewal, a documented pattern of non-compliance can complicate your file. Immigration officers are trained to evaluate whether applicants demonstrate respect for U.S. law. Tax violations, especially repeated or unresolved ones, can raise uncomfortable questions about intent. This is why seniors and immigrants are disproportionately affected. Seniors often receive foreign pensions or maintain long-standing accounts overseas that predate retirement. Immigrants frequently maintain financial ties to their countries of origin, property, family accounts, inheritance interests. These are normal human realities, but the U.S. tax system operates on worldwide income reporting. If you're a U.S. tax resident or citizen, the obligation follows you globally. Now, before we go any further, if you want ongoing updates like this, especially as we move closer to 2026 and implementation details continue to evolve, make sure you're subscribed and notifications are turned on. Regulatory shifts rarely arrive with loud announcements. Staying informed early is one of the simplest ways to protect yourself, because next we need to shift from understanding the risk to understanding exactly what you should do starting now. So this never becomes your crisis story. So let's move from awareness to action, because this is the part that actually protects you. If you do nothing else after watching this, do these 5 things. First, create a complete inventory of every financial connection you have outside the United States. And I mean everything, not just what feels significant. Bank accounts, even if they only hold a few thousand. Joint accounts with parents or siblings, retirement or pension accounts in your country of origin, foreign life insurance policies that accumulate cash value, brokerage or investment accounts, real estate you co-own, business interests, anything tied to your name or that you have signature authority over. For each one, document the institution name, country, account number if applicable, and most importantly, the highest value it reached at any point during the calendar year, not just December 31st, the peak balance. That number determines your reporting obligations. Second, determine whether you're required to file an FBAR, not just going forward, but for prior years as well. Remember, if the combined value of all your foreign financial accounts exceeded $10,000 at any time during the year, you had a filing requirement. If you're realizing right now that you may have missed FBAR filings in previous years, don't panic, but don't ignore it either. The IRS has streamlined compliance procedures specifically designed for taxpayers whose non-compliance was non-willful. That means you genuinely didn't know about the requirement. These programs can significantly reduce or even eliminate penalties if handled properly. But timing matters. Voluntary correction is always viewed more favorably than waiting until you're contacted. Third, evaluate whether you'll cross the Form 8938 thresholds under the Titan framework. If your foreign assets approach $25,000 at year end or $40,000 at any point during the year in applicable situations, begin gathering documentation now. Statements, valuation records, ownership percentages. Assemble them early. Waiting until tax season creates unnecessary stress and increases the likelihood of mistakes. Fourth, review any foreign pension or government benefit you receive. Many seniors assume that because a pension originates overseas, it's taxed only in that country. But the United States taxes worldwide income for citizens and tax residents. In some cases, tax treaties allow credits or exclusions to prevent double taxation, but those benefits must be claimed correctly. This is not an area for guesswork. If you receive foreign retirement payments, social insurance benefits, or distributions from overseas accounts, speak with a professional who understands international taxation. And fifth, especially if you're in the citizenship process, maintain organized copies of everything: tax returns, FBI confirmations, Form 8938 filings, correspondence. Keep digital and physical backups. If USCIS requests documentation, the ability to provide it immediately demonstrates seriousness and compliance. It also dramatically reduces stress during interviews. Now, I want to bring this into real life. Last spring, I spoke with a woman I'll call Maria. She was 68 years old, originally from India, and had lived in the United States for more than 2 decades. She raised her children here. She worked here. She paid her taxes every year without fail. When she applied for citizenship, she believed it would be straightforward. She had followed every rule she understood. During her naturalization interview, the officer asked a simple question: "Do you maintain any financial accounts in foreign countries?" Maria hesitated. She did have one, a savings account in India with around $15,000. She kept it for practical reasons. When she traveled back to visit family, it was convenient. It wasn't hidden. It wasn't secret. It simply existed as part of her life before immigrating. But she had never filed an FBAR. She didn't know she needed to. Under older enforcement realities, that detail might have gone unnoticed unless triggered by something else. But integrated systems revealed the inconsistency. Her answer prompted further review. What should have been a celebratory milestone turned into 8 months of uncertainty. She had to hire a tax professional, retroactively file FAIRs, prepare written statements explaining that her non-compliance was non-willful, provide years of documentation. The financial cost approached $3,000. The emotional cost was far greater. For months, she worried that a mistake born of ignorance, not dishonesty, could derail her citizenship. Eventually, her case was resolved. The government accepted that she hadn't intended to conceal anything. She was approved, but she told me something that has stayed with me. If someone had explained this to me earlier, I would have fixed it immediately. I never wanted to do anything wrong. That's why we're having this conversation now before 2026, before filing season 2027, before automated cross-checks become even tighter, because the difference between a smooth process and a prolonged crisis is often just early information. And next, we need to talk about the penalties. Not to frighten you, but so you understand exactly why proactive compliance matters. Now let's talk about the part most people avoid: penalties. Not because fear is helpful, but because clarity is. When you understand the real consequences, you're far more likely to take simple preventive steps that keep you out of trouble. If you are required to file an FBAR and you don't, the penalties can be severe. For non-willful violations, meaning the IRS believes you didn't intentionally try to hide anything, the penalty can be up to $10,000 per account per year. Notice that wording carefully: per account, per year. If someone had 2 foreign accounts and missed 3 years of filings, the numbers add up quickly. If the IRS determines the violation was willful, in other words, that you knew about the requirement and consciously chose not to comply, the penalty escalates dramatically. It can reach the greater of $100,000 or 50% of the account balance. Imagine having $60,000 sitting in an overseas account and facing a potential $30,000 penalty simply because reporting wasn't handled correctly. And that's separate from any tax owed on income generated by that account. Form 8938 carries its own consequences. The baseline penalty for failing to file when required starts at $10,000. If the IRS issues a notice and the failure continues, additional penalties can accrue, potentially up to $50,000. On top of that, if foreign income associated with unreported assets is underreported, accuracy-related penalties and interest can apply as well. There's another issue most people don't realize: the statute of limitations. Under normal circumstances, the IRS has 3 years to audit a tax return, but if substantial foreign income is omitted or required foreign asset disclosures are not properly filed, that window can extend to 6 years. In cases involving allegations of fraud, there may effectively be no time limit at all. That means unresolved issues don't necessarily disappear with time. They can follow you. And if you're in the immigration system, penalties are only one dimension. USCIS evaluates whether applicants demonstrate good moral character. Repeated tax noncompliance, unresolved liabilities, or findings of willful reporting failures can complicate that assessment. Again, this doesn't mean an automatic denial, but it can mean deeper questioning, document requests, and longer processing timelines. Now, I want to pause here and address something that may be weighing on many seniors, specifically U.S. Social Security benefits. The 2026 reporting changes do not alter how your American Social Security retirement or disability benefits are taxed. That framework remains the same. Depending on your combined income, up to 85% of your U.S. Social Security benefits may be taxable, just as under current law. Nothing about this new reporting environment changes that calculation. What does draw attention, however, are foreign Social Security type benefits and overseas pensions. If you receive payments from another country's retirement system, whether it's the Canada Pension Plan, the UK State Pension, Germany's public pension system, or any similar program, those payments are generally considered part of your worldwide income. As a U.S. tax resident or citizen, in some cases, tax treaties between the United States and the other country determine how that income is treated. You may qualify for foreign tax credits to prevent double taxation, but those treaty benefits must be applied correctly and documented properly. Beginning in 2026, the questions surrounding foreign pensions and overseas benefits are positioned more prominently in the reporting process. That means fewer opportunities for accidental omission. And for retirees who have spent years dividing time between countries, this is especially important to review now, not later. The goal here is not to overwhelm you, it's to remove uncertainty. When you understand what is changing and what is not, you can approach this with confidence rather than fear. And now, let's close this out with the 3 principles that matter most moving forward. At the end of the day, this entire conversation comes down to 3 core principles. And if you remember nothing else from this video, remember these first. Knowledge creates leverage. The overwhelming majority of people who run into trouble with foreign asset reporting are not criminals. They are retirees, parents, long-term residents, hardworking immigrants who simply didn't realize how far U.S. tax jurisdiction extends. The fact that you're hearing about this before the 2026 tax year even begins puts you in a completely different position. You have time, you can review your accounts, you can correct past oversights if necessary, you can speak to a qualified professional. Most compliance crises don't explode because of complexity, they explode because of delay. Second, professional guidance is not an expense, it's protection. International tax reporting sits at the intersection of multiple rule systems, IRS regulations, Treasury reporting requirements, and for many of you, immigration law. A preparer who only handles basic domestic returns may not fully understand FBAR obligations or treaty nuances. If you have foreign pensions, overseas property, or accounts abroad, it is worth consulting someone who works specifically with international reporting. The upfront cost of doing it correctly is almost always far lower than the financial and emotional cost of fixing mistakes under pressure. And third, protect the life you've built. Whether you came to the United States decades ago or recently, whether you're approaching retirement or building your career, your stability here matters. A technical reporting requirement should never be the thing that jeopardizes your peace of mind. Compliance is not about fear, it's about control. When your paperwork is clean, when your disclosures are accurate, when your records are organized, you remove uncertainty from the equation, and that freedom is powerful. If this breakdown gave you clarity, take a moment to like the video and share it with anyone in your family or community who might fall into these categories, especially seniors who may not spend hours researching regulatory updates online. And if you haven't already, subscribe and turn on notifications. As we move closer to 2026, implementation details and enforcement practices can evolve, and staying informed early is one of the simplest ways to stay protected. Before we wrap up, a quick but important reminder. Everything discussed here is for general formational purposes only. This is not personalized legal or tax advice. Individual circumstances vary. Tax treaties differ and policies can change. Always verify details through official government sources such as IRS.gov and USCIS.gov, and consult a qualified tax professional or immigration attorney about your specific situation. You've worked too hard and sacrificed too much to let a reporting technicality create unnecessary stress in your life. Stay informed, stay organized, stay proactive. When you understand the rules ahead of time, they don't control you. You control the outcome.